Welcome to This Explainer. Today, we're diving into something you literally use every single day, probably without realizing the massive financial machinery humming right beneath the surface. We're talking about your digital wallet. Now, you might just think of it as a handy payment tool, right? A quick way to split a tab or grab a coffee. But the truth is actually way more fascinating. It's an incredibly intricate acquisition wedge. Think of it like the ultimate Trojan horse in your pocket, perfectly engineered to transform a basic utility app into a full-blown financial ecosystem. So I want you to completely reconsider that simple utility app you use to order takeout or hail a ride. You tap your screen, your food magically arrives, money leaves your account, it's totally frictionless. But what if I told you that processing your payment is actually the least important part of that transaction for the company behind the app? Today, we're going to unpack how these digital wallets aren't just holding your cash. They're actively building massive, high-margin banking empires right there in your pocket. To really understand how this works, let's look at Indonesia. With a massive, mobile-first population of 270 million people, it is basically the ultimate, hyper-competitive testing ground for apps racing to bank the unbanked. And to get why, you just have to picture the geography. We're talking about a nation spread across thousands of islands. Trying to build traditional brick-and-mortar bank branches to reach everyone across that fragmented landscape, it's practically impossible. But smartphone penetration? It's absolutely through the roof. And that creates the perfect laboratory for tech giants to deploy sophisticated digital wallets, capturing millions of users who are stepping into the financial system for the very first time. So how do these platforms actually pull you in? Let's take Grab's OVO wallet as an example. They use this brilliant two-tiered architecture. You start with OVO Basic, which has literally zero onboarding friction. But, how does an unbanked user actually get real money into it? Well, they use offline to online agents. Local mom-and-pop shops and street-level merchants essentially act as human ATMs. They take physical cash from a customer and instantly convert it into a digital float right there on the app. But here's the catch. That basic digital cash is trapped within their ecosystem. You can't withdraw it. If you want to unlock peer-to-peer transfers and way higher balance limits, you've got to upgrade to OVO Premier. And the price for that upgrade? You trade your most valuable asset, your verified identity data. And that brings us to the secret engine powering this whole operation, the escrow paradigm. See, a digital wallet isn't just a way to pay for things. Behind the scenes, it operates as a massive escrow account. Think about it. When millions of individual users each hold just a tiny balance in their wallets for everyday stuff, it aggregates. It builds up into this massive, highly stable pool of floating capital for the parent company. They're taking your transient, everyday cash and systematically turning it into a vast ocean of cheap retail liquidity. Okay, so what do they actually do with all that verified identity data and that huge pool of liquidity? They lend it out. But they definitely don't do it like a traditional bank would. Instead, they use algorithmic AI credit scoring. Every single innocuous piece of metadata, like how often you order a ride to work, the volume of your weekly food deliveries, your geolocation stability, even how consistently you top up your wallet balance, it is all constantly fed into a proprietary algorithm. They're literally using your everyday app behavior to generate a highly accurate alternative credit score. And this unlocks dynamic lending limits for millions of people who have never even had a traditional bank account. Which brings us to a really powerful reality from our source research. Consumer credit is the true monetization engine here. Processing the payment for your 5-minute taxi ride, that has razor-thin margins. Honestly, it barely covers their server costs. But using the behavioral data from that daily commute to confidently offer you a pay-later microloan, that is exactly where the massive profit margins live. The digital wallet is really just the acquisition wedge. Aggressive consumer lending is the actual business model. And these companies are pretty much forced to pivot to lending because basic payments have become a total commodity. Take Indonesia again. The government introduced a universal QR code standard called QRIS. With 38 million merchants nationwide now using this single interoperable network, literally any app can facilitate a payment. It doesn't matter if you're buying a latte at a high-end cafe or a snack from a street vendor's cart, the proprietary payment moat they used to have is just completely gone. To survive, these apps had to evolve way beyond just payments. Which leads us to our next section, the Superapp typology. As you can see here, different super apps start with different core functions, that acquisition wedge we were just talking about. Some kick things off as messaging apps, while others start as payment wallets, shopping platforms, or transport apps like ride-hailing. But regardless of where they begin, the fundamental goal is always exactly the same. Capture a daily, highly repetitive habit from you, the user, and then build a much broader platform ecosystem right on top of that initial wedge. Now, if we plot the trajectory of these apps based on their integration patterns, a really fascinating picture emerges. Notice the super wallets down there. They have highly focused integration, strictly clustering around niche financial services. But if you follow that trajectory arrow pointing up towards the everything apps, it maps exactly how a platform uses its initial wedge to achieve full-service integration. It evolves rapidly from a single-purpose tool into a highly diversified, all-encompassing daily operating system.
Breaking that academic research down a bit further, we get a taxonomy of 4 distinct categories. You've got your golden super apps that focus heavily on the golden triangle of messaging, payment, and shopping. Then you have super wallets, which remain strictly financial. Moving on, there are the everything apps, like Grab or WeChat, that encompass a massive, incredibly diverse ecosystem. And finally, you have niche super apps that are tailored to specific verticals. What this really proves is that a digital wallet is almost never the end game. For the most ambitious tech companies out there, it's literally just step 1 on the path to becoming a full-fledged everything app.
Moving right along, let's look at the e-wallet oligopoly battle.
Looking at this competitive matrix, we can see how these rivals are using completely unique wedges to capture users in a really saturated market. Take Grab, for instance. They rely on daily ride-hailing and aggressive high-yield savings to lock in your funds. GoPay, on the other hand, leverages Tokopedia's e-commerce dominance alongside fully compliant Sharia savings to appeal to a very specific demographic. Then you have ShopeePay, dominating almost entirely through massive e-commerce integration. And finally, Dana acts as the neutral utility player, specifically reaching out into rural areas. So everyone is using a totally different hook, but make no mistake, they are all fishing in the exact same pond for your liquidity.
But here is a super fascinating twist. Despite players like Grab and Ovo building this incredibly sophisticated financial plumbing system, ShopeePay heavily dominates the projected top-of-mind awareness metric for 2026, commanding a massive 41%. Why is that? Well, it turns out that the frictionless, everyday habit of scrolling for online shopping deals and chasing subsidized shipping acts as a slightly stronger, much more immediate psychological wedge for everyday consumers than complex financial routing does. So, to fight back and win the ultimate loyalty of the user, platforms are pioneering what's known as the rec wallet paradigm. And honestly, this is an absolute masterstroke in user experience. Just think about the nightmare of traditional banking for a second. Scheduling a branch visit, sitting through awkward interviews, making manual deposits, waiting days for approval. The rec wallet eliminates all of that entirely. By integrating a fully licensed digital bank directly inside the familiar ride-hailing app, they change the game. Using the identity data you've already provided, you can open a high-yield, fully regulated bank account in seconds without ever having to leave the app you use to order your lunch.
The big takeaway here is that the global era of apps burning through billions of dollars in cash just for user acquisition, that is definitively over. Public markets simply won't tolerate it anymore. The race today is all about completely leveraging the app as an indispensable operating system for high-margin financial software and aggressive consumer lending. Simply put, the wallet was the hook, profitability is the catch. Which leaves us with one final, pretty immense question to ponder as we wrap up this explainer. We've seen exactly how these platforms expertly use daily convenience as a wedge to build complete financial empires, essentially out of thin air. But as they consolidate into these unified everything apps, what happens when the exact same app that routes your morning commute and delivers your dinner also holds the unilateral power to dictate your credit limit, score your behavior, and manage your life savings? That is a staggering amount of power held in a single interface. Definitely something to think about the next time you simply tap to pay. Thanks so much for joining me today, and I'll catch you next time.